Hey everyone, thank you for watching. For more insights into everything financial, please follow, like, or subscribe below. Today we're going to talk about risk, how we define it in the finance and investment world, and how most normal people define risk. If you've ever sat down and talked to a financial advisor about risk, they've probably mentioned standard deviation, which basically is volatility, meaning that whatever investment they're talking about, be it a stock, a bond, a mutual fund, or an ETF, has performed over the last week, month, or year, or however long it's been around. So the risk of financial loss doesn't really figure into the equation. Now, if I were to ask you to define risk, you'd probably ask something along the lines of, well, what are the chances I lose my money, right? So right off the bat, there's this disconnect between how risk is defined in finance, sometimes badly, and how most normal people would define risk. And this distinction is important to keep in mind as an investor. Now, all of this is designed to help us manage an uncertain and unknowable future. We look at an investment's past so that hopefully it can tell us how it's going to perform in the future. But deep down inside, we all know we can't predict the future, right? No advisor, not me, Warren Buffett, or anyone for that matter, can tell you how an investment will perform tomorrow, next week, next month, and forget about next year. The best we can do is to properly set our expectations to manage the uncertainty associated with the future. And we can do this by taking a more longer term view to investing. Know that prices will fluctuate, but your emotions don't necessarily have to. So, the next time you sit with your financial advisor and they begin to talk to you about the riskiness of an investment, make sure that you ask questions so that you're properly prepared to ride the highs and lows of its price movement. As always, if you have any questions, please add them in the comments below, and thank you for watching.